All right, let's unpack this. We are diving deep today into a topic that, well, it's incredibly important for anyone who has assets and is thinking about how they want to transfer them,
Hmm.
either during their lifetime or maybe as part of their legacy.
Right.
We're talking about the often complex world of U.S. federal gift tax and charitable donations, specifically the compliance and planning sides that our source material really lays out.
And our guide for this deep dive is, it's a really comprehensive document. It breaks down the fundamental concepts, the essential rules, and gives practical examples to help make sense of it all.
Yeah, it looks like a great foundation.
It really is.
Yeah.
Perfect for getting well-informed on these topics pretty quickly.
Exactly. So our mission today is to take this detailed source material and, distill it down into the most important actionable insights for you, our listener.
Yeah, what do you really need to know?
What are the core concepts? The practical implications you absolutely need to grasp about transferring wealth during your lifetime. We want you to make informed decisions, avoid potential pitfalls. So let's just jump right into the heart of it.
Okay. Let's start with the big picture. The foundation for understanding gift tax is realizing it's part of a larger system. It's called the Unified Transfer Tax System.
Unified transfer tax system.
Yeah, this system links together the tax on gifts you make during your life. That's the gift tax. And the tax on property transferred when you pass away, which is the estate tax.
Ah, so they're connected. They're not treated as totally separate things, even though one happens while you're alive and the other, well, after. How does that unification actually work?
Well, the key concept really is that the tax calculation is cumulative. It builds over an individual's entire lifetime.
Cumulative.
Right. The taxable gifts you make while living, they get added to the value of your taxable estate at death.
Mm-hmm.
And the total transfer tax liability is calculated based on this cumulative value. The system is designed partly to stop people from avoiding estate tax just by giving everything away right before they die without any, tax consequence along the way.
Ah, okay, that makes sense. So if I make a big taxable gift during my life, it doesn't just trigger a tax thing now, it also impacts my potential estate tax later because it uses up some of that cumulative limit.
Precisely. And to manage that cumulative tax, the system gives a pretty significant benefits called the unified credit. Sometimes you'll hear it called the applicable credit.
The unified credit.
Right.
This is the number that always sounds like a lot of money. In 2023, the source says this credit is based on cumulative taxable transfers of $12,920,000.
Mm-hmm.
Okay, what does that number actually mean for our listeners, practically speaking?
It means that in 2023, an individual could make total cumulative taxable gifts during their life and leave a taxable estate at death, totaling up to $12.92 million. Wow. And the unified credit will basically zero out the federal gift or estate tax liability on those transfers. So you can think of that $12.92 million as your lifetime and death tax-free transfer allowance, essentially.
So for most people then, that $12.92 million exclusion is high enough that they probably won't end up owing any federal gift or estate tax. That sounds like good news.
Yes, and that's a critical point.
Mm-hmm.
For many people, that's true. However, and this is something the source material makes really clear, and it's super important for compliance, even if you don't owe tax because of this large credit, you might still have a filing requirement for gift tax purposes.
Ah.
And, importantly, any taxable gifts you do make use up a portion of this $12.92 million lifetime exclusion amount.
That distinction is really key, isn't it? Not owing tax right now doesn't mean you can just ignore the rules or the paperwork.
Exactly.
Every taxable gift you make kind of chips away at that big $12.92 million bucket. Which brings us to the fundamental question, what exactly is a taxable gift in the eyes of the IRS?
Well, the source gives a very broad definition, and it's a crucial starting point. It says, every transfer of money or property, whether real or personal, tangible or intangible, for less than adequate or full consideration in money is a gift.
Less than adequate or full consideration. Okay, so if I sell my boat to my neighbor for what it's actually worth, even if that neighbor happens to be my brother, it's not a gift because I got full value back.
Correct.
But if I just give him the boat or maybe sell it to him for $1, that transfer of value for way less than it's worth is the gift part for tax purposes.
Precisely. The intention is to transfer value to someone else without getting something of equivalent value back. That's the core idea.
Right.
And this could be cash, stocks, real estate. It could even be forgiving a debt if you don't expect to be repaid.
Okay, so that's what a gift is. But even with that definition, there are really important ways to transfer value without it counting against that $12.92 million lifetime exclusion right away. These are the exclusions. Let's start with, well, probably the most commonly used one for lifetime planning, the annual exclusion.
The annual exclusion, yes, it's a cornerstone of lifetime gifting strategy. For 2023, the source specifies that a donor can exclude the first $17,000 of gifts made to each recipient in a calendar year.
$17,000.
And that amount gets adjusted for inflation each year.
$17,000 per person you gift to or year. So I could give my son $17,000, my daughter $17,000, my favorite niece $17,000, and my best friend $17,000, all in the same year. And assuming these are the right kind of gifts, which I guess we need to talk about, none of those count as taxable gifts, and none use up my $12.92 million lifetime exclusion.
That's right.
Wow, that's a significant amount of wealth that can be moved over time that way.
Right. It really is. It's a powerful tool for shrinking a potentially taxable estate over decades. And the source also highlights how married couples can effectively double this with something called gift splitting.
Gift splitting. Okay, how does that work?
Well, if a married couple agrees and, elects to split gifts made by either spouse during the year, a gift made by just one spouse is treated as if it was made one half by each spouse.
Okay, so if I give my daughter, say, $34,000, my spouse and I can agree to treat that as if I gave her $17,000 and my spouse gave her $17,000.
Exactly. Since each of you has your own $17,000 annual exclusion for that daughter.
Right.
That single $34,000 gift is fully covered by your combined annual exclusions. $17K from you, $17K from your spouse.
Ah.
So this allows a married couple to give up to $34,000 per recipient per year, tax-free and exclusion-free, based on those 2023 numbers.
That's a huge benefit for married couples trying to plan their estate. But there's a really critical limitation on this annual exclusion, isn't there? The source mentions something about it not applying to every single type of gift. This sounds like where people could get tripped up.
This is a crucial point, yes.
Yeah.
The source material emphasizes it repeatedly. The annual exclusion is not available for a gift of a future interest.
A future interest. Okay. Why is this one specific type of gift treated differently? And what happens if a gift is considered a future interest, even if its value is, say, way under that $17,000 annual limit?
Well, the source is very clear on the consequence, and it's significant.
Right.
Because a gift of a future interest doesn't qualify for the annual exclusion, you are generally required to file a gift tax return that's Form 709, regardless of how small the value of that future interest gift is.
Regardless of the value. Even like $1,000.
Even then. And even if your total cumulative gifts are way below the $12.92 million credit amount, so no taxes owed right now, the filing requirement is still triggered. And critically, the full value of that future interest gift does use up a portion of your $12.92 million lifetime exclusion amount, starting from $1.
Whoa. Okay, that's a major aha moment right there.
Yeah.
So I might think I'm making a small, harmless gift by putting, say, $5,000 into a trust for someone where they won't get the money for a few years. And I assume, the $17,000 annual exclusion covers that, but because it's a future interest, I actually have to file a gift tax return. And that $5,000 immediately eats into my $12.92 million lifetime exclusion. That completely changes the planning implications.
It absolutely does. Understanding the difference between present interests and future interests is vital. It directly impacts whether you can use the annual exclusion or if you immediately start using your lifetime credit and trigger that filing requirement. We'll definitely need to spend more time on what makes something present versus future with some clear examples.
We absolutely will. That point alone is worth this whole deep dive. But before we get there, the source also highlights some other frankly incredible ways to transfer value that have an unlimited gift tax exclusion. They don't use up your annual exclusion or your lifetime credit at all.
Unlimited exclusions, yes. These are very powerful planning tools. The source lists 4 key categories.
Okay.
First, payments made directly to an educational institution on behalf of someone for tuition.
Tuition only.
Tuition only. Second, payments made directly to a healthcare provider on behalf of someone for medical care.
Okay.
Third, charitable gifts to qualifying organizations.
Right.
And fourth, transfers between spouses, which fall under the marital deduction rules.
Okay, let's break those down a bit. Direct payments for tuition. So if my granddaughter's in college and I write a check directly to the college bursar for her tuition bill, is that an unlimited gift no matter how much the tuition is?
Yes, that's exactly right, according to the source. Key things. Paid directly to the educational organization, and the source specifically notes it's only for tuition.
Right, not books or housing.
Correct. Doesn't cover books, room, or board. But you can pay significant tuition expenses for any number of people, children, grandchildren, friends, whoever, without it affecting your annual exclusion or your lifetime credit. It's a fantastic way to support education without gift tax issues for the donor.
That is incredibly valuable for families. Okay, similarly, direct payments for medical care. If say my elderly parent needs expensive medical treatment and I pay the hospital or the clinic directly for their care, that's also unlimited.
Correct. Paid directly to the healthcare provider for the medical care of the donor. Again, no limit on the amount for gift tax purposes. These two unlimited exclusions for education and medical expenses are specifically designed to allow people to help others with these often huge costs without triggering gift tax.
Makes sense. And charitable gifts are also unlimited for gift tax. So I can give any amount of money or property to a qualified charity during my life, and it won't trigger gift tax or use my lifetime exclusion.
That is correct for gift tax purposes.
Yeah.
As long as the organization is a qualified charity, a Section 501c3, the gift tax exclusion is unlimited.
Okay.
Now, it's very important to remember, as the source material gets into later, that while there's no gift tax limit, there are definitely income tax deduction limits. Those depend on your income and the type of property you donate.
Ah, okay, good distinction.
We'll get into that complexity later when we talk about non-cash contributions to charity.
Okay, point taken. Unlimited for gift tax, but different rules for income tax deductions. And finally, the marital deduction. The source mentions this is an unlimited exclusion for transfers between spouses.
Yes. Gifts made to your spouse during your lifetime, provided certain requirements are met, qualify for an unlimited marital deduction.
Why is that one unlimited? What's the the thinking behind that in the tax system?
Well, the tax system generally views a married couple as a single economic unit for transfer tax purposes. So the tax is essentially deferred, pushed off until the death of the surviving spouse.
Yeah, deferred.
Right. So you can give any amount of property to your U.S. citizen spouse during your life, or leave any amount to them at your death, and it can pass tax-free using this unlimited marital deduction. It gives couples flexibility in managing their assets during their joint lives.
Unlimited transfers between spouses sounds pretty straightforward, but the source immediately brings up a potential complication. Something about terminable interests and how they relate to QTP. What's a terminable interest and why could it mess up the marital deduction?
Right. A terminable interest is basically an interest in property that might end or fail based on some specific event or just the passage of time. For example, maybe you give your spouse the right to live in a house for their lifetime, but then the house automatically goes to your children after they die.
Okay, so their right terminates.
Exactly. And the general rule is, if you give your spouse a terminable interest like that, it doesn't qualify for the unlimited marital deduction.
Okay, so if the spouse's interest could just sort of disappear and the property pass to someone else without ever being fully controlled by the spouse or taxed in their estate later, the unlimited deduction isn't allowed up front. Is that the idea?
That's exactly the idea. The rule exists to make sure that the property getting the marital deduction eventually gets brought back into the transfer tax system, usually in the surviving spouse's estate. However, there's a major and very frequently used exception for something called qualified terminable interest property, or QTIP.
QTIP.
Transfers of QTIP do qualify for the unlimited marital deduction, even though the spouse's interest terminates at their death. Why? Because the law has specific rules built in to ensure that property is taxed in the surviving spouse's estate later.
So QTIP is a way to get the unlimited marital deduction even if the spouse doesn't get full outright control of the property, as long as it meets specific conditions that guarantee it'll be taxed later. What are those requirements for property to be QTIP, according to the source?
The source lists 4 strict requirements that have to be met for property to qualify for QTIP treatment and get that unlimited marital deduction.
Okay.
1. The done spouse must be entitled to receive all the income from the property for their entire lifetime. And this income has to be paid out at least annually.
All the income annually, got it.
2. No person other than the done spouse can receive any distributions of income or principal from the property during the done spouse's lifetime. The spouse is the only one who can benefit while they're alive.
Only the spouse benefits during their life.
Okay. 3. If the property isn't income producing, maybe it's vacant land, the done spouse must have the right to require that the property be made productive. Like, they could force a trustee to sell the land and reinvest in something that pays dividends.
Okay, the right to make it productive.
And 4, crucially, the property must be subject to payment of its pro rata share of estate taxes upon the death of the surviving spouse.
Ah, there's the guarantee. That last requirement ties it all together. The tax is deferred, but it is collected when the surviving spouse dies. These are pretty technical rules, focusing on control over income and distributions. Let's look at example one from the source. It seems to show how timing and the actual marriage relationship interact with this marital deduction.
Right. Example 1 involves Casey and Pat. So Casey gives Pat a $50,000 ring in April when they get
Okay,
engaged.
engaged, not married yet.
Right. Then, after they get married in July, Casey gives Pat $75,000 cash for a personal bank account. Both are U.S. citizens. The question is about Casey's marital deduction for these transfers.
And the source says the marital deduction is $75,000. That makes sense. The $75,000 cash gift happened after they were married, so it qualifies for the unlimited marital deduction. Uses up none of Casey's lifetime exclusion.
Correct. But the $50,000 engagement ring that was given before the marriage, at that moment in April, they weren't spouses.
So the marital deduction just doesn't apply to the ring. The source does note, though, that the $50,000 engagement ring would be eligible for the annual gift tax exclusion.
Yes. So for that $50,000 ring given before marriage, Casey can use the $17,000 annual exclusion.
Okay,
The remaining amount, $50,000 minus the $17,000 exclusion, is $33,000. That $33,000 is a taxable gift.
right.
This $33,000 taxable gift uses up $33,000 of Casey's $12.92 million lifetime exclusion. And it likely triggers a gift tax filing requirement, that Form 709, because the gift value, $50K, was more than the annual exclusion, $17K.
This example really shows powerfully that the timing relative to the marriage is absolutely critical for the marital deduction. And it shows how gifts made before marriage are treated totally differently, potentially using the annual exclusion and that lifetime credit right away.
It's a very clear illustration. Okay, so we've covered what a gift is, the annual exclusion and gift splitting, the unlimited exclusions, including that important marital deduction, and the QTIP rules. Now, let's circle back to that point that can trip people up. Present versus future interests. Because this distinction is vital, it dictates whether that annual exclusion is even available.
Right. The $17,000 exclusion only works for certain types of gifts.
The source defines a future interest by contrasting it with a present one. It says that postponement of a right to use, possess, or enjoy the property distinguishes a future interest from a present interest.
Postponement of the right to use, possess, or enjoy. So, if the person getting the gift has the immediate ability to benefit from it right now, use it, control it, get income from it, that's a present interest.
Exactly. And as the source states, a present interest does qualify for the annual exclusion. And assuming it's a complete gift, it generally removes the property from the donor's estate for tax purposes if the gift's value is below the exclusion amount or if credit is used.
Whereas a future interest, because that right to immediate benefit is delayed until sometime later, that does not qualify for the annual exclusion.
Correct.
And as we established earlier, that means it immediately starts using your $12.92 million lifetime exclusion, and it triggers a filing requirement even for a small gift.
That's the consequence. The source also adds a little wrinkle. A present interest without ascertainable value also doesn't qualify for the annual exclusion. So if you can't put a clear dollar value on the present right to use or the income stream, you can't apply the exclusion to it.
Okay, that makes sense. You need to value what you're excluding. Let's really drill into the examples provided in the source now. What are some concrete situations that are classified as future interests? Where is the enjoyment postponed?
Okay, the source lists several key examples of future interests. First, reversions. This is where you gift property, but you keep the right to potentially get it back at some point in the future.
Ah, like it might revert back to me.
Right. Second, remainders. This is where the recipient only gets the property after someone else's interest ends, like after a life estate finishes. Their right to possess the property is postponed until later.
Okay, they have to wait.
Third, mandatory income accumulation in a trust. If a trust document requires the trustee to just keep the income and add it back to the principal for a while, distributing it later,
Yeah.
the beneficiary doesn't have a present right to that income stream. Their right is postponed.
Even if income is being earned, they can't get it yet.
Exactly. And fourth, those present interests without ascertainable value we just mentioned, if the current benefit is so uncertain you just can't value it reliably.
Okay, I definitely see the pattern there. In all those cases, the recipient can't just walk up right now and say, this is mine to fully use or enjoy today. Their full benefit is delayed somehow.
Correct.
So what about examples of present interests? What does that look like? What does qualify?
The source provides these examples of present interests, that do qualify for the annual exclusion. Outright gifts of cash or property. If I hand you $100 cash or the keys to my car, you have immediate use and control. That's present.
Simple enough.
Mandatory income distribution from a trust. Contrast this with accumulation. If a trust requires the trustee to pay out the income to a beneficiary, at least annually, that beneficiary does have a present right to that income stream, even if the principal itself is distributed later.
Ah, so getting the income now makes it present.
Right. Life estates. Giving someone the right to use or live in a property for their lifetime, starting now, even though someone else will own it eventually. The right to current use is immediate.
Okay.
Estates for a term certain. Similar idea, giving someone the right to use property for a specific number of years, starting immediately.
Like use of the beach house for the next 5 years.
Exactly. Bonds or notes. Even if the interest isn't actually paid until the bond matures way down the road, the legal right to receive the principal and the eventual interest exists now. And unrestricted transfers of life insurance policies. Once you transfer full ownership of the policy itself, the new owner has immediate rights regarding that policy, like borrowing against it, changing beneficiaries, etc., even though the death benefit payout is obviously in the future.
Okay, that distinction between present and future interest is absolutely paramount for your planning, isn't it? It's like the first hurdle for using that $17,000 annual exclusion.
It really is.
If it's a future interest, you cannot use that buffer. It immediately starts eating into your lifetime credit, and you probably have a filing requirement. So when you're setting up trusts or making gifts that have conditions or delays, you have to scrutinize whether it creates a future interest.
It truly is one of the most common areas where people make unintentional taxable gifts. Now, another important concept related to this is whether a gift is considered complete or incomplete.
Complete versus incomplete gifts. Does this also impact whether the gift tax rules apply at all?
Yes, absolutely. The source explicitly states that only complete gifts are subject to gift tax and qualify for the annual exclusion. If a gift isn't legally complete yet, it's not a gift for tax purposes yet.
Okay, so the IRS doesn't tax incomplete transfers. That makes sense. When is a gift considered complete then, according to the source?
A gift is complete when the donor has basically given up dominion and control over the property. They've let go.
Dominion and control.
Right. The source notes that a gift can be complete even if the recipient isn't actually born yet, as long as their identity is, ascertainable, like, to my first grandchild. It's also considered complete even if there's some possibility the property might revert back to the donor way down the line, provided the donor has otherwise fully relinquished control now.
Okay. And when is a gift not considered complete? Meaning it's incomplete and therefore not subject to gift tax at that moment.
The source points to two main scenarios where a gift is incomplete: if it's conditional, or if the donor retains the power to revoke it.
Conditional gifts, like, I'll give you this money if you graduate from college next year, that kind of thing.
Exactly. That's a condition precedent. The transfer isn't really final until the condition is met, so the gift remains incomplete until the recipient actually graduates.
Makes sense. And a revocable gift. That's where the donor keeps the power to basically take the property back or maybe change who gets it later.
Yes. If the donor reserves the power to revoke the gift entirely or change the beneficiaries, the gift is incomplete. The source clarifies that if the donor later gives up that power, then the gift becomes complete at that moment.
Ah, so it can become complete later.
It can. However, there's an important distinction. If the donor's power to revoke or change beneficiaries only terminates upon the donor's death, it's generally not considered a completed gift for gift tax purposes during their life. Instead, the value of that property is typically included in the donor's estate at death and potentially subject to estate tax then.
Okay, so the core idea for completeness really boils down to whether the donor has truly let go of control. If they can still take it back or change the term significantly, it's probably incomplete and not taxed as a gift yet.
Exactly.
This distinction seems key for knowing the precise moment a transfer actually becomes subject to all these gift tax rules we're discussing.
It is. Now, before we jump into actually calculating the tax, let's clear up a common misunderstanding. Who pays the gift tax? Is it the person receiving the gift?
Yeah, I think a lot of people who receive a large gift worry about that. Do they owe income tax on it? Or maybe even a gift tax themselves?
It's a common worry, But the source provides clarity on this. It states, the recipient of a gift pays no gift tax, and the gift does not represent taxable income to the recipient.
Oh, that's a relief for the recipient. So the burden and the responsibility for navigating these gift tax rules, the potential filing requirements, it all falls squarely on the donor, the person making the gift.
Correct. The person receiving a gift generally just receives it tax-free from their perspective.
That's good to know.
Although, as the source hints, and we'll definitely discuss more later, the recipient's tax basis in the gifted property is affected, and that can have future income tax implications for them if they eventually sell the property. But that's a different issue than gift tax.
Okay, basis. We'll park that for a moment. Let's put all these rules together now and talk about calculating the taxable gifts for a given year. We know what a gift is, we know the exclusions, we know about present-future interests, complete and complete. How do you actually figure out the number that counts against that big $12.92 million lifetime exclusion?
Okay, the source summarizes the calculation pretty clearly. You start with the gross value of all gifts made during the calendar year.
Gross value.
For non-cash gifts, stocks, real estate, whatever this is, their fair market value, or FMV, on the date you actually made the gift.
FMV on the date of the gift. Got it.
From that total gross value, you then subtract any applicable annual exclusions. That's the $17,000 per dummy, or $34,000 if you're married and elect gift splitting.
Okay, subtract annual exclusions.
You also subtract the unlimited marital deduction for any qualifying gifts made to your spouse.
Subtract marital deduction.
And you subtract any unlimited charitable gifts made to qualifying organizations.
Subtract charitable gifts. Got it.
And the number that's left after you subtract all those exclusions, that's your taxable gifts this year.
Taxable gifts this year. Okay.
Yeah. And this year's taxable gifts are then added to any taxable gifts you made in prior years to arrive at your cumulative lifetime gifts.
Back to that cumulative idea.
Exactly. The actual gift tax you might owe for the current year is calculated based on this cumulative total using a progressive tax rate schedule. But then that calculated tax is reduced by the amount of your available unified credit.
Right.
So as we discussed, you only actually pay gift tax out of pocket if your cumulative taxable gifts have exceeded that big $12.92 million exclusion amount, meaning you've used up all your unified credit.
So even if I have, say, $50,000 in taxable gifts this year, I don't necessarily write a check to the IRS for gift tax if I still have a large chunk of my $12.92 million exclusion available.
Right.
That $50,000 just reduces the amount of exclusion I have left for future gifts or for my estate. And this is the key point, again, a filing requirement might still exist, right?
Exactly. The source confirms that filing Form 709 is generally required if you make any gift to a single donor that exceeds the annual exclusion amount, $17,000 for a single donor or $34,000 for a married couple electing gift splitting.
Okay.
Or if you make any gift of a future interest, regardless of its value.
Right, the future interest rule again.
Filing is how the IRS keeps track of your cumulative taxable gifts over your lifetime and how much of that lifetime exclusion you've used up.
Okay, let's walk through example 2 with Jack Smith. The source uses him to really bring this calculation and the filing requirement to life. So Jack is single. In early 2023, he made 3 gifts. $20,000 cash to someone named Adele, a sculpture valued at $4,000 to Barry, and Zorro Corp stock with $40,000 to Christine. No other gifts that year.
Okay, let's apply the rules for Jack as a single taxpayer. Gift to Adele, $20,000 cash. The annual exclusion is $17,000. The amount exceeding the exclusion is $20,000 minus $17,000, which is $3,000. So $3,000 is a taxable gift.
Okay, $3K taxable there.
Gift to Barry. A sculpture valued at $4,000. This is less than the $17,000 annual exclusion. So the taxable amount is $4,000 minus $4,000, which is $0. No taxable gift there.
0 for Barry. Got it.
Gift to Christine. Zorro Court stock worth $40,000. This clearly exceeds the $17,000 annual exclusion. So the taxable amount is $40,000 minus $17,000, which is $23,000. That $23,000 is a taxable gift.
Okay, so adding those up. $3,000 from the gift to Adele, plus $0 from Barry, plus $23,000 from Christine. Jack's total taxable gifts for 2023 are $26,000.
That's right. And as the source notes, Jack would only actually owe gift tax if his cumulative taxable gifts over his entire lifetime exceeded the $12.92 million exclusion. Assuming he hasn't made huge taxable gifts before, he likely won't owe tax this year.
Right.
But the source explicitly states he must file a gift tax return, Form 709. Why?
Because some of the gifts went over the limit.
Exactly. Because the value of at least 2 of his gifts, the $20 K to Adele and the $40 K to Christine, exceeded the $17,000 annual exclusion amount per done. That excess triggers the filing requirement, even if no tax is due right now.
See, that filing requirement is so important even when the tax bill is zero. Now, the example asks, what if Jack was married and he and his spouse decided to elect gift splitting for these same 2023 gifts? How does the calculation change then?
Gift splitting. This significantly changes the picture because now they can use the doubled annual exclusion of $34,000 per dunny. Let's rerun the numbers. Gift to Adele, $20,000 cash. The available exclusion with splitting is $34,000. Since the gift, $20K, is less than the exclusion, $34K, the taxable amount is $20,000 minus $34,000.
Basically zero taxable for Adele. Yeah?
Gift to Barry, $4,000 sculpture. Available exclusion, $34,000. Gift forte is less than exclusion, $34K. So taxable amount is $4,000 minus $4,000.
Yeah.
Also $0.
Zero for Barry still.
Gift to Christine, $40,000 stock. Available exclusion, $34,000. The gift, $40K, exceeds the exclusion, $34K. So the taxable amount is $40,000 minus $34,000, which is $6,000.
Wow. Okay, so by electing gift splitting, their total taxable gifts for the year are $0 plus a zero plus $6,000, which equals only $6,000.
Exactly.
That's a massive reduction from the $26,000 calculated when he was single just by using that gift splitting election.
It vividly demonstrates the strategic power of gift splitting for married couples. It helps minimize their taxable gifts, preserve more of their individual lifetime exclusions, and reduce the likelihood of owing gift tax or even having significant cumulative taxable gifts build up over time.
Yeah, huge difference.
Though it's worth noting, they would still need to file Form 709. You generally have to file the return to properly make the gift splitting election and report the gifts, even if the resulting taxable amount is low or zero.
Okay, makes sense. This example is fantastic. It really shows how planning, like using gift splitting, can drastically change the outcome and the amount that eats into your lifetime exclusion. Let's look at one more example from the source, example 3 with Jill. She's a single taxpayer making various types of transfers, and this one helps illustrate how those unlimited exclusions factor into the calculation.
Okay, example 3. Jill, who is single, made 5 separate $20,000 transfers in 2023, totaling $100,000. Let's break down each one based on the rules we've discussed. First transfer, $20,000 to the Library Building Fund for City Community College, which the example states is a public charity.
Okay, a charity.
Second transfer, $20,000 paid to City Community College specifically for her granddaughter Izzy's tuition.
Tuition payment.
Third transfer, $20,000 paid directly to her granddaughter Izzy for Izzy's living expenses.
Okay, cash to Izzy.
Fourth transfer, $20,000 paid to City Hospital to help pay for her friend Jack's surgery.
Medical payment.
And fifth transfer, $20,000 paid directly to her friend Jack to help him pay for home care after his surgery.
Cash to Jack. Okay. All right, let's apply our rules to each one of these. First, the $20,000 to the college library fund. That's a contribution to a public charity. Our source says charitable gifts have an unlimited gift tax exclusion. So that's $0 taxable gift here. That one seems easy.
Correct. Unlimited charitable exclusion applies. Zero taxable gift.
Second, the $20,000 paid to the college specifically for Izzy's tuition. This sounds like that direct payment rule.
It is. It's a direct payment to an educational institution specifically for tuition on behalf of a DUN. The source says this qualifies for an unlimited gift tax exclusion. So, another $0 taxable gift.
Okay, so those first two transfers are completely excluded, no impact on annual or lifetime limits.
Exactly. They effectively use those unlimited exclusions.
Now the third one, $20,000 paid directly to Izzy for living expenses. This is not a direct payment to the school for tuition, nor is it direct payment for medical care. It's just a gift of cash directly to Izzy.
Correct. This is treated as a standard gift, and it's subject to the annual exclusion. Jill is single, so her annual exclusion is $17,000 per person. She can use that $17,000 against this $20,000 gift to Izzy.
Okay, so the taxable amount is $20,000 minus $17,000, which equals $3,000.
$3,000 taxable gift for that transfer.
Fourth, the $20,000 paid to the hospital for her friend Jack's surgery. This sounds like the direct medical payment rule.
It does. It's a direct payment to a healthcare provider, the hospital, for medical care on behalf of DUN Jack. This qualifies for the unlimited medical expense exclusion. So, $0 taxable gift for this one.
Another zero. Okay. Finally, the fifth transfer, $20,000 paid directly to her friend Jack to help him pay for home care. Now, even though it's for a medical-related purpose, the payment went to Jack, not the provider.
Exactly. That's the key difference. Like the gift to Izzy for living expenses, this is treated as a standard gift of cash directly to Jack. It's subject to the annual exclusion. Jill can use her $17,000 annual exclusion against this $20,000 gift.
So the taxable amount is again $20,000 minus $17,000, which is $3,000.
Correct. Another $3,000 taxable gift.
Okay, so let's tally that up. Out of 5 transfers totaling $100,000, only 2 of them actually resulted in a taxable gift amount. The $20,000 given directly to Izzy for living expenses, and the $20,000 given directly to Jack for home care. In both cases, the $17,000 annual exclusion reduced the taxable portion to just $3,000.
That's right. So Jill's total taxable gifts for the year are $3,000 from the gift to Izzy, plus $3,000 from the gift to Jack, equaling $6,000 total.
$6,000.
This $6,000 uses up $6,000 of her $12.92 million lifetime exclusion. And because she made gifts that exceeded the $17,000 annual exclusion amounts, the 20K gifts to Izzy and Jack, she must file a gift tax return, Form 709 for 2023.
This example is incredibly helpful. It shows so vividly which types of transfers fall under those really powerful unlimited exclusions. Direct payments for tuition, direct payments for medical and charity. And which ones, even if they're intended for those purposes, become standard gifts subject to the annual exclusion and potentially the lifetime credit, simply because of how the money was paid directly to the individual versus directly to the institution.
It really reinforces the importance of understanding those very specific requirements for the unlimited exclusions. It's not just the purpose, it's the mechanics of the payment.
Absolutely. And just to quickly recap the annual exclusion rules again. The source confirms that for the $17,000 34K married, annual exclusion to apply, the gift must meet 3 conditions, right?
Yes. It must be a present interest. The recipient has the immediate right to use or enjoy it. It must be complete. You've actually relinquished control. And its value must be under the annual limit per person, unless it qualifies as one of those unlimited exclusions we just went through.
Perfect summary. That really brings Section 1 to a close. Okay, now that we've got a handle on the core mechanics of the unified system and the essential gift tax rules, let's shift our focus. Let's talk about a common and strategically important type of gift, gifting non-cash property. This introduces some unique considerations and, as you mentioned earlier, a really critical planning trade-off involving basis.
Right. When you decide to gift assets other than cash, things like stocks, bonds, real estate, maybe even valuable personal items like art or collectibles, the same basic gift tax rules we just covered still apply. The value of the gift for tax purposes is the fair market value, FMV, of that property on the date you make the gift.
And the annual exclusion still applies to the FMV of that non-cash property. So I can give someone up to $17,000 worth of stock or $34,000 if married and splitting gifts per year without using my lifetime credit, assuming it's a present interest gift.
Yes, that's correct. And this is actually one of the significant advantages of making lifetime gifts compared to transferring property only at death. You can utilize those annual per done exclusions year after year using non-cash assets to systematically reduce the size of your potential taxable estate over time. This is entirely separate from your big $12.92 million lifetime exclusion. That annual exclusion opportunity simply isn't available for assets transferred as part of your estate when you pass away.
Okay, so if I have a substantial estate, maybe one that might exceed that $12.92 million threshold someday, giving away appreciated assets like stocks up to the $17,000 or $34,000 annual exclusion limit each year to multiple family members, that's a very effective tax-free way to shrink the future taxable estate.
It is. It's a cornerstone estate planning strategy, especially for larger estates. However, and this is where that critical consideration comes in, there is a major, major difference between gifting property during your life and leaving that same property to someone in your will. And that difference revolves around the recipient's tax basis in the property.
The basis dilemma. Okay, let's break this down. Why is the recipient's tax basis so incredibly important when we're talking about property transfers?
Basis is absolutely fundamental because it determines the amount of capital gain or loss the recipient will have to report when they eventually sell the property. The calculation is pretty simple. Sale price minus tax basis equals capital gain or loss.
Okay.
So a lower basis means a higher potential capital gain when the property is sold, which in turn means potentially more income tax due for the recipient down the road.
Got it. Higher gain, potentially higher tax. So what's the rule for figuring out the recipient's tax basis when property is gifted to them during the donor's life? Let's assume the property has gone up in value.
Okay, for property that has appreciated, meaning its current fair market value is higher than what the donor originally paid for it, or their basis. The source states that the recipient's basis, the person getting the gift, is generally the donor's original basis. It carries over.
The donut basis carries over. Okay, let's use an example. If I bought some stock 20 years ago for, say, $5 a share, and it's now worth $150 a share, and I gift that stock to you today, your tax basis in that stock is just $5 a share, not the current $150.
That's exactly right, for purposes of calculating your gain if you sell it later. The appreciation that occurred while I held the property that jumped from $5 to $150 isn't taxed at the moment I give it to you. But that potential gain is essentially transferred along with the stock.
Okay.
So if you then turn around and sell that stock for, say, $160 a share, your capital gain is calculated as $160, your sale price, minus your $5 basis, resulting in a $155 gain per share.
Wow, $155 gain.
Right. And that $155 gain includes the $145 of appreciation that happened while I owned it, plus the extra $10 of appreciation that happened while you owned it.
So by gifting an appreciated asset, okay, I successfully removed it from my potential estate, and maybe I used my annual exclusion efficiently. But I've also transferred my low-cost basis to the recipient, and that could potentially stick them with a pretty large capital gains tax bill down the road if they decide to sell it.
That's a significant implication, yes. Now, compare that to the rule for property that is inherited, received after someone passes away.
Okay, what's the basis rule for property someone gets through inheritance?
For inherited property, the rule is very different and generally much more favorable for the recipient. Their basis is usually the fair market value of the property at the date of the decedent's death. There's also an alternate valuation date 6 months later that estates can sometimes elect, but let's stick with date of death for simplicity.
The FMV at death. Okay, this is what people often call a step-up in basis, right? So going back to my stock example, if I held onto that stock, the one I bought for $5 and is now worth $150 until I died, and you inherited it from my estate when it was worth $150 a share, your tax basis would actually be $150 a share, not my original $5 basis.
Precisely. And the incredible benefit here is that all the appreciation in value that occurred during my lifetime, that entire $145 jump from $5 to $150, is never subject to income tax. It just disappears for capital gains purposes.
Wow, it's never taxed.
Right. So if you then sold that inherited stock for $160 a share, your capital gain would only be a $160 sale price, minus your $150 stepped-up basis,
Right.
resulting in just a $10 gain per share. That gain only represents the appreciation that occurred after you inherited it.
Okay, this is where that core planning trade-off becomes crystal clear.
It really does. The source materials treatment of this highlights a critical decision point for anyone holding appreciated assets. Option 1. Gift the appreciated property during your life. It's great for using those annual gift tax exclusions and reducing the size of your potential taxable estate. But you burden the recipient with your lower original basis, potentially leading to a larger capital gains tax for them when they sell.
Okay, that's gift during life. Option 2.
Option 2. Hold on to that highly appreciated property and leave it to someone at your death. The downside: it will be included in your estate for estate tax purposes. It might use up some of your $12.92 million estate tax exclusion, or even result in estate tax if your total estate exceeds that amount. But 2T, the huge advantage is that the person inheriting it gets that valuable stepped-up basis,
Right.
which could mean they pay significantly less capital gains tax, maybe even zero, on all the appreciation that happened during your lifetime when they eventually sell.
That's the heart of the trade-off, laid out perfectly. Which strategy is better?
Well, it's not a simple answer, is it? It sounds like it depends entirely on your specific situation.
It really does. Is your estate likely to be over the $12.92 million exclusion threshold? How much has the property actually appreciated? What are the recipient's likely income tax bracket and their plans for the asset? Are they likely to sell it quickly or hold it for a long time?
Yeah, all those factors matter.
It requires looking at both the potential gift or estate tax consequences for you, the donor, and the potential future income tax consequences for the recipient. There's just no one-size-fits-all-right answer here.
It requires really careful consideration of your total financial picture and your long-term goals. Gifting appreciated property is good for using annual exclusions, good for reducing estate size, but it comes with that potential income tax hit later for the recipient. Inheriting, avoid that income tax hit on the historical appreciation, thanks to the step-up, but the asset stays in your estate for potential estate tax. It's a balancing act, a very important balancing act in planning. And this transitions us quite smoothly into our next section, charitable donations of non-cash property. We touched on the unlimited gift tax exclusion for charity earlier.
Right.
But the income tax deduction side is where the detailed rules, especially for non-cash items, become really crucial for planning.
Right. So if I want to donate something other than cash to charity, maybe stocks or property, a car, there's no gift tax issue. We established that. But the amount I can actually deduct on my income tax return involves a whole different set of specific rules.
Exactly. And the very first requirement, as the source points out, is that the organization you donate to must be a qualified charity. That generally means recognized by the IRS as a Section 501c3 organization.
Okay.
This includes most public charities and also private foundations, although the deduction rules can sometimes differ slightly between those two types, especially regarding AGI limits.
Okay, step one, verify the charity's status. Now, the source says the amount you can deduct depends on the type of property you donate, and interestingly, how long you've owned it. This sounds like it could get complicated quickly.
It does add layers of rules, yes. Let's start with what the source calls ordinary income property. What gets classified as ordinary income property in this context, and how does that affect the deduction amount you can claim?
Okay, ordinary income property for charity.
The source defines ordinary income property here as assets that, if you sold them at fair market value on the date you donated them, would result in ordinary income or a short-term capital gain.
Not long-term capital gain.
Right. So this includes things like inventory from your business, assets you've held for 1 year or less because selling them would generate short-term gain, investment or personal use assets that have actually decreased in value below what you paid for them, your basis.
Oh, interesting. Depreciated property, too.
Yes, because selling them would result in either an ordinary loss or a limited capital loss. And also, the portion of gain on certain business assets that's subject to depreciation recapture rules that part is treated as ordinary income.
Okay, so basically property that if I sold it, the gain wouldn't get that favorable long-term capital gain treatment, or property that has actually lost value since I acquired it.
Correct. Now, for donating ordinary income property to charity, the source states your income tax deduction amount is limited. It's the lesser of the property's adjusted basis, which is typically your costs may be adjusted for depreciation, or its fair market value at the time you contributed.
The lesser of my cost or its current value,
Yeah.
why is the deduction limited that way for OI property? Why not just FMV?
Well, the underlying logic is that you generally shouldn't get a charitable deduction for an amount that represents income you would have had to recognize as ordinary income or short-term gain if you had sold the property instead. And if the property has decreased in value, you wouldn't get a tax benefit for the full original cost if you sold it. You'd have a loss. So your deduction is limited to its lower current value. It prevents you from getting a deduction that's more valuable than the tax result of selling.
Okay, that makes a certain kind of tax sense. Now, what about the other main category? Long-term capital gain, LTCG property. This sounds more promising for appreciated assets.
It generally is. LTCG property for contribution purposes is appreciated capital gain property that you have held for more than 1 year.
Held more than a year and it's gone up in value.
Right. This includes most typical investment assets like stocks, bonds, or real estate held for over a year that have increased in value. It also includes personal use assets that have appreciated, like art or collectibles held long-term. And it includes business assets held long-term, but only to the extent the gain isn't that ordinary income depreciation recapture part.
Okay. And the deduction rule for LTCG property donated to a public charity, is it better?
Generally, yes. The source says the deduction for LTCG property donated to a public charity is usually its fair market value at the time of contribution.
FMV. Okay, so if I donate stock I bought for $10 a share 5 years ago, and it's now worth $100 a share, I can typically deduct the full $100 per share value on my income taxes.
Yes, that's the general rule for donating LTCG property to a public charity. The tax law provides this more generous deduction, letting you deduct the full FMV instead of just your basis, partly as an incentive to encourage people to donate appreciated assets that would otherwise trigger a long-term capital gains tax if they sold them.
That's a huge difference compared to ordinary income property where you're stuck with the lesser of basis or FMV, but you said generally, which usually means there are exceptions or special rules lurking.
You anticipated correctly. There are a couple of important ones the source highlights. The first applies specifically to tangible personal property, that is, LTCG property, but is put to an unrelated use by the charity.
Okay, tangible personal property. So things I can touch and move, like artwork, jewelry, collectibles, furniture.
Exactly.
An unrelated use, what does that mean?
Right. If you donate tangible personal property, That will be LTCG property if you sold it. It's appreciated, you held it over a year. But the charity uses it for a purpose that's unrelated to its tax-exempt charitable mission.
Hmm.
Then your deduction is limited. It gets knocked down to your adjusted basis in the property, not the full FMV.
Ooh. Okay, this sounds like a classic trap. Let's take an example. If I donate a valuable painting, maybe I bought it for $10,000 years ago, it's now worth $50,000 to an art museum. And the museum puts it on display as part of its collection.
That's a related use for an art museum, right?
Yes, that would be a related use.
So in that case, my deduction would be the full $50,000 FMV. Yeah. But if that same museum immediately takes my painting and auctions it off just to raise general funds, that's considered an unrelated use for the painting itself.
That is precisely the rule and the reasoning.
And in that case, my deduction would be limited to my original cost, just $10,000, even though the painting was worth $50,000. That's exactly how it works. The law wants to provide the full FMV deduction, mainly when the charity directly uses the donated item for its intended charitable purpose. If they just immediately convert it to cash, the deduction is aligned more closely with your original investment, your basis.
That's a vital planning point. It means you really need to understand, maybe even get in writing, the charity's intended use for your tangible personal property donation if you want to claim the full FMV deduction. You can't just assume.
Communication with the charity is critical there, yes.
Okay. What's the other special situation the source mentions regarding non-cash donation rules?
The source details specific rules for donating qualified vehicles, which means cars, trucks, boats, or airplanes.
Ah, vehicle donations. That's a really common type of non-cash gift people make.
It is, and frankly, often by the time someone donates an old personal vehicle, its fair market value is already less than what they originally paid for at their basis. So technically, it might already be ordinary income property anyway, meaning the deduction would be limited to the lower FMV under the rules we already discussed.
Okay.
But the rules get even more specific when the charity sells the vehicle, which they very frequently do.
Right, they usually auction them off. How does the charity selling the vehicle change the donor's deduction rule?
Okay, if the vehicle's claimed fair market value is more than $500 at the time you contribute it, your deduction is generally limited to the lesser of A, the gross proceeds the charity receives from selling it, or B, the vehicle's FMV on the date you contributed it. And remember, if FMV was already below your basis, the deduction is capped at FMV anyway.
Okay, let me process that. So if I donate my old car, and maybe the Blue Book value suggests it's worth $7,000 FMV, but the charity only manages to sell it at auction for $5,500, my deduction is capped at $5,500, not the $7,000 FMV I might have thought I could claim, assuming my original cost was higher than $7K.
Correct. Your deduction is tied directly to what the charity actually gets when they liquidate the asset. This prevents donors from claiming inflated FMV deductions when the charity gets much less.
Makes sense.
The source adds that if the charity sells the vehicle for $500 or less, your deduction is limited to the lesser of $500, or the vehicle's FMV, again, subject to the overall basis rule if FMV is less than basis.
Okay. These rules seem quite specific, clearly designed to prevent abuse and align the donor's deduction value more closely with the actual cash benefit the charity receives from the donation. Let's use example 4 about Bill's painting to illustrate that difference between ordinary income and LTCG property donations, and maybe touch on that tricky unrelated use rule again. Bill bought a painting for $25,000 5 years ago and wants to donate it to a museum.
Okay, scenario 1 in the example. Bill's painting currently has a fair market value of only $20,000. He's held it for 5 years, so that's long term. But its value has depreciated from his $25,000 cost.
Right, so since it depreciated below his basis, even though he held it long term, for deduction purposes, it's treated as ordinary income property.
Exactly.
Therefore, the deduction is the lesser of his adjusted basis, $25,000, or the current FMV, $20,000. His deduction is limited to $20,000.
That matches the OI property rule perfectly. Now, scenario 2. The painting's FMV is $30,000. Now it's appreciated. He bought it for $25K, held it 5 years, now it's worth $30K.
Okay, this is clearly long-term capital gain property. It appreciated, held more than a year. So assuming the museum is going to put it on display, which is a related use for an art museum, the deduction rule is the full FMV, which is $30,000.
Right. That's the general rule for LTCG property to a public charity for related use. Now, the note below the example in the source is crucial because it brings in that unrelated use rule again.
Yes, the note says if the museum, instead of displaying the $30,000 painting as part of their collection, immediately sold it, maybe to fund operations or buy something else, then Bill's deduction would be limited. It wouldn't be the $30,000 FMV anymore.
Correct, because selling it is considered an unrelated use for the painting itself.
So his deduction would be limited to his adjusted basis, which is $25,000.
There's that trap again. Even though it was LTCG property and its value was genuinely $30,000 because the charity used it in an unrelated way, selling it instead of displaying it, Bill's deduction gets knocked down to his original cost, $25,000.
This example is excellent. It really illustrates how both the property type, OI vs LTCG, based on holding period and depreciation, and the charity's ultimate use of the property directly impact the amount you can actually deduct on your income taxes.
It ties those concepts together very clearly, yes.
Okay. Now, even once you've correctly determined the value of your non-cash contribution using all these rules basis versus FMV-related use, vehicle sales proceeds, there's still another layer of limitation we need to consider: the adjusted gross income AGI limitations.
Yes, the AGI limits. These essentially put a cap on the total amount of charitable contributions you can deduct in a single year, regardless of how generous you are or how much your donations are valued at. The limits are calculated as a percentage of your adjusted gross income, and the specific percentage depends on both the type of property donated, cash, OI, LTCG, and the type of charity receiving it, usually public charity versus private foundation.
Okay, percentage limits based on my income. What are the primary AGI limits mentioned in the source for contributions made to public charities, which is probably the most common scenario?
Okay, for contributions made to public charities and certain types of foundations, the source lists these main limits. Cash contributions are generally limited to 60% of your AGI.
60% for cash. Okay.
Ordinary income property contributions are limited to 50% of your AGI.
50% for OI property.
And long-term capital gain property contributions are limited to 30% of your AGI.
30% for LTCG property? Huh. It's interesting that LTCG property, which gets that potentially more generous FMV valuation for the donation amount, actually has a lower AGI percentage limit, 30%, compared to cash, 60%, or even OI property, 50%, when donated to a public charity.
It is interesting. It's sort of the tax code's way of balancing the benefit. You get the potentially larger FMV deduction for appreciated property, but the amount you can use in the current year is subject to a tighter AGI limit compared to cash, which gets the highest AGI limit.
Okay.
The source also briefly mentions that contributions to certain types of private foundations, specifically private non-operating foundations, generally have even lower AGI limits, typically 30% for cash and OI property and only 20% for LTCG property. But let's focus on the public charity limits.
Right, 60 of 50, 30 for public charities. Now, what happens if you donate different types of property in the same year? Say you give some cash, some OI property, and some LTCG property. You've got contributions subject to multiple different limits. How do you calculate your total deduction when these limits interact? Is there an order?
Yes, there's a very specific order, and this is crucial for calculating the correct total deduction if you have multiple types of contributions in one year. The source specifies you apply these limits sequentially. 1. First, you figure out the deduction for your cash contributions, up to the 60% AGI limit.
Cash first, up to 60%.
2. Second, you calculate the deduction for your ordinary income property contributions. The overall limit here is 50% of AGI, but this limit is applied after considering the cash deduction you already calculated. So effectively, the OI deduction can't push your total deduction, cash plus OI, over 50% of AGI.
Okay, so OI is second, up to 50% total with cash.
3. Third, you calculate the deduction for your long-term capital gain property contributions. The limit here is 30% of AGI. However, this limit is also subject to the overall 50% limit applied in Step 2. So the LTCG deduction is the lesser of 30% of AGI, or 50% of AGI minus the cash and OI contributions already allowed.
Whoa, okay. The order really matters. You calculate the max allowed for cash first. Then you figure out how much room is left under the 50% AGI ceiling for the EY property. And then you figure out how much room is left for the LTCG property subject to both its own 30% AGI limit and whatever is left under that overall 50% AGI ceiling after accounting for cash and OI. This sounds like it requires very careful step-by-step calculation.
It definitely does. And example 5 in the source, featuring Joe Kelly, is a perfect illustration of exactly how these steps work together in practice. This example is a bit complex, but it's invaluable for understanding the process.
Okay, let's walk through Joe Kelly slowly. His adjusted gross income, AGI, is $100,000. In 2023, he makes 3 contributions, all to public charities, $15,000 cash to the United Way, some old personal furniture donated to Goodwill. He originally bought it for $25,000, but its fair market value today is only $10,000. A sculpture donated to an art museum. He bought this 5 years ago for $20,000, and it's now appraised at $30,000 FMV.
Okay, AGI is $100,000. Let's follow the steps exactly as outlined in the source's solution for Joe Kelly's deduction.
Identify the contributions and determine their type and deductible value.
$15,000, subject to the 60% AGI limit.
Held long-term but depreciated. FMV $10K basis $25K. So it's treated as ordinary income property for deduction. The value is the lesser of bases, $25K, or FMV, $10K. So $10,000 deductible value, subject to the 50% AGI limit.
Held 1 year, appreciated. FMV, $30K basis, $20. So it's long-term capital gain property. Assuming the museum will use it for a related purpose, like displaying it, the deductible value is the FMV, $30,000, subject to the 30% AGI limit.
Okay, got the types and initial values. $15 cash, 60%, $10 AOI, 50%, $30 LTCG, 30%. AGI is $100K. Now, step 2, apply the 60% limit for cash.
Right. The maximum cash deduction is 60% of Joe's AGI, $100,000, which is $60,000. Joe's cash contribution is $15,000. Since $15,000 is less than the $60,000 limit, the full $15,000 cash contribution is deductible this year.
Okay, $15 cash allowed. Step 3, apply the 50% limit for ordinary income property. The overall limit is 50% of AGI, $50,000. But we need to subtract the cash contribution already allowed. So the remaining capacity under the 50% limit is $50,000 minus the $15,000 cash, which leaves $35,000.
Correct. Joe's OI property contribution, the furniture, is valued at $10,000. Since $10,000 is less than the remaining $35,000 limit available for OI property, the full $10,000 OI property contribution is deductible this year.
Okay, full $10 KOI allowed. Now, step 4, apply the 30% limit for long-term capital gain property. This is the trickiest one. The source says the limit for LTCG property is the lesser of two amounts. What are they again?
It's the lesser of A, 30% of AGI. In Joe's case, 30% of $100,000 is $30,000.
Okay.
Or B, 50% of AGI, $50,000 minus the total amount of contributions already allowed under the 60% cash and 50% OI limit. So calculation B is $50,000 minus $25,000, which equals $25,000.
Ah, okay. So the limit for LTCG property this year is the lesser of $30,000 from calculation A and $25,000 from calculation B. The lesser amount is $25,000.
Exactly. That $25,000 is the maximum deduction Joe can take for LTCG property this year.
Now, Joe's actual LTCG contribution, the sculpture, was valued at $30,000, but because of this AGI limit calculation, he can only deduct $25,000 of the sculpture's value this year. Is that right?
That's exactly right. The AGI limitation cuts his LTCG deduction short for this year.
Okay. So, step 5. Calculate Joe's total charitable contribution deduction for 2023. We just sum up the amounts allowed for each type based on these limits.
Right. It's $15,000 allowed cash, plus $10,000 allowed OI property, plus $25,000 allowed LTCG property, which equals the $50,000 total deduction for Joe in 2023.
So even though the combined potential value of his contributions was $50K plus $10K plus $30K equals $55,000, his actual income tax deduction for the year is limited to $50,000. It's capped by those AGI limits and the ordering rules.
That's the impact of the AGI limitations in a year, with multiple types of contributions. And there's one more piece. Step 6 in the source's example is calculate the carry forward.
Ah, the carry forward. What happens to the part he couldn't deduct? He contributed $30,000 worth of the sculpture, LTCG, but the limit only allowed him to deduct $25,000 this year. Does he lose the other $5,000?
No, he doesn't lose it entirely. That difference, the $5,000, $30,000 contribution minus the $25,000 allowed deduction, is the amount that gets carried forward to potentially be deducted in future tax years.
Okay, carry forward. The source mentions that you don't lose the deduction completely. What are the general rules for carrying over contributions that exceed the AGI limits? How long do you have?
Generally, any contributions that exceed the applicable AGI limits in a given year can be carried forward for up to 5 additional years.
5 years, okay. And when you use those carryovers in a future year, how do they apply? Do they get some kind of preferential treatment, or do they still have to follow the rules?
No special treatment, unfortunately. The source states that carryovers are applied on a first-in, first-out basis, meaning you use the oldest carryovers first. And, importantly, they are still subject to the AGI limitations of the year in which they are used.
Ah.
Okay, so next year, Joe could potentially deduct that $5,000 LTCG carry forward, but only after applying any current year contributions he makes next year, and only up to whatever that future year's applicable AGI limits are for LTCG property. The limits apply every single year to both current contributions and carryovers.
This Joe Kelly example is genuinely invaluable. It really shows how you have to meticulously identify the property type, correctly value it using the right rules, basis versus FMV, understand those special conditions like related use, then apply the correct AGI percentage limits in the right sequence, and finally, track any carryovers. It's complex, but clearly essential for maximizing your charitable deduction, especially when you're giving non-cash assets.
It absolutely highlights the importance of careful record keeping and, frankly, often careful calculation when dealing with non-cash charitable contributions.
And speaking of record keeping, the source wraps up this section by emphasizing the substantiation requirements for non-cash contributions. What kind of paperwork do you absolutely need to have to claim these deductions successfully?
Yeah, proper documentation is non-negotiable. The IRS needs proof. For any non-cash contribution where the total claim deduction is more than $500, you must file Form 8283, Non-Cash Charitable Contributions, along with your tax return. This form requires details about the donated property and the charity.
Okay, Form 8283 required for over $500 total in non-cash gifts for the year. Is there a higher threshold that requires even more detailed proof, like an appraisal?
Yes, if you are claiming a deduction of more than $5,000 for any single item or for a group of similar items, like, say, a collection of stamps or coins donated together,
Mm-hmm.
you are generally required to obtain a qualified written appraisal of the property's value from a qualified appraiser.
Over $5,000 needs an appraisal.
Generally, yes.
Yeah.
And the appraiser usually has to sign a section of that Form 8283, and the charity also has to acknowledge receiving the property on that form if the claimed value is over $5,000.
Okay, a formal written appraisal for items or groups valued over $5,000. Are there any common exceptions to that appraisal rule?
The source notes a key exception for contributions of publicly traded securities like stock in a major company that trades on an exchange. You typically don't need a formal appraisal for these because their fair market value is easily verifiable from market quotes on the date of the gift.
Okay, that makes sense. So Form 8283 for over $500 in total non-cash gifts, and generally a qualified written appraisal required for items or similar groups valued over $5,000, unless it's something like publicly traded stock. Ensuring you have this documentation correct seems crucial because presumably without it, the IRS could just deny your deduction entirely.
Absolutely. The substantiation rules are there to verify both the existence of the donation and its claimed value. No paperwork, potentially no deduction.
Wow. Okay. We have covered a tremendous amount of ground in this deep dive. Let's try to quickly recap the major areas. We started way back with the foundation that unified gift and estate tax system, the big $12.92 million lifetime exclusion, but also that critical filing requirement even when no tax is due. We explored the essential gift tax exclusions, the incredibly useful annual exclusion, 17K, 34K, and how gift splitting supercharges it for married couples. And those powerful unlimited exclusions for direct tuition payments, direct medical payments, gifts to charity, and transfers to a spouse, including navigator those tricky QTIP rules for terminable interest.
Right. We then clarified that vital distinction between present interests, which qualify for the annual exclusion, and future interests, which don't, triggering filing and using lifetime credit. We also looked at the difference between complete gifts taxable now and incomplete gifts taxable later or maybe never if revocable until death.
And then we shifted to the nuances of gifting non-cash property during life. We highlighted that major planning trade-off regarding the recipient's tax basis, contrasting the valuable step-up in basis for inherited property versus the donor's carryover basis for gifted property, and really thinking about how that impacts the recipient's future capital gains tax bill.
It just wrapped up a really detailed look at the income tax deduction rules for charitable donations of non-cash property, identifying qualified charities, the different deduction valuation rules for ordinary income property, lesser of basis FMV, versus long-term capital gain property, usually FMV, that important unrelated use trap for tangible personal property, and the specific rules for donated vehicles.
Plus, navigating those complex adjusted gross income limitations, 605030 for public charities, and the crucial ordering rules for applying those limits when you have multiple types of gifts, using that Joe Kelly example to see how the allowed deduction and carryovers are calculated. And finally, hitting on the crucial substantiation requirements, Form 8283, and appraisals needed to actually claim your deduction.
It's a lot, but understanding these core concepts, these rules, these limitations that we've pulled from the source material, it's really indispensable for anyone who's considering transferring assets to family members or making significant charitable contributions. It's not just about knowing the rules exist, it's about understanding how they apply to your unique situation so you can plan effectively, maximize the benefits where the law intends, and avoid those nasty, unexpected tax consequences.
It truly emphasizes that the simple act of giving is just one piece of the puzzle. How you structure that giving, what specific assets you choose to give, who the recipient is, spouse, charity, child, friend, and even how the payment is made, direct versus indirect.
Huh?
All of these details have cascading tax implications, both for you as the donor and potentially for the recipient down the line. So, given all this complexity, we've just unpacked the difference between present and future interests. That really critical basis trade-off for appreciated property, the incredibly detailed AGI limits and ordering rules for charity. What does this deep dive really tell us about the value of careful, proactive planning when it comes to managing your assets and thinking about your legacy?
Well, I think it underscores that navigating wealth transfer effectively, whether during life or at death, is far from a simple check-writing process. It requires not just generosity, but a really informed approach to the tax rules. Knowing these details, the ones we've dug into today, allows you to make truly intentional decisions. Decisions like, should I maximize my annual exclusion gifts each year? Should I gift this highly appreciated stock now or leave it in my will? Am I structuring my charitable contributions in a way that actually provides the intended tax benefit? It tells us that these nuances, these details, are incredibly powerful, and that understanding them, maybe, for many people, working with professional advisors who live and breathe this stuff, is absolutely key to achieving your financial goals for your assets and for the people and causes you care most about. The planning makes all the difference.
Indeed it does. The nuances are powerful. Definitely something for all of us to think about as we consider our own planning goals.
Absolutely. There's always more to consider, always more to learn in the world of tax and financial planning.
Well, thank you for joining us for this deep dive into the intricacies of gift tax and charitable contributions.